Hi, everybody. This is Stefanos Chen. I'm a real estate reporter for the New York Times. Welcome. I have been covering real estate since the middle of the last financial crisis of '08, but the present moment feels very different. Contract signings in Manhattan were down more than 50% after the first month of lockdown, and most of those deals began before the quarantine. New listings have plummeted, and the vast majority of properties are still off limits to potential buyers. The market was already in a slump before the pandemic, with prices down about 20% from the peak, which was in 2016. So, where will prices end up? Is now a good time to buy? And what will the market look like on the other side of the lockdown? I'm excited to be joined today to talk about all this with Jonathan Miller, who is the president of Miller Samuel Appraisers, Nancy Pax, the president of Nancy Pax Data Services, which is a real estate consultancy and data provider, and Frances Katzen, one of the top brokers at Douglas Elliman Real Estate. A quick note before we start, this conversation is being recorded and is audio only, and you can submit questions anytime using the Q&A feature in Zoom. Please tell us your name and your town so we can shout that out as well. Jonathan, we're going to start with you. I know you hate this question, but I think everyone has it on their minds. Have we hit the bottom? And before you answer, give us some context for this moment. I know you've been covering this for so long that you can sort of put this in perspective with 9/11 and Lehman Brothers in '08. How does this compare?
So everybody always says this time it's different. So I'm going to start by saying this time it's different. When we went through 9/11, what was very different, and I think also similar to the experience that we had with the Lehman moment, I call it, the financial crisis in '08, is that once the event occurred that, so for example, in September 11th, there was a September 12th, a 13th, a 14th, and there was some sense of progress in terms of moving away from the crisis and seeing light at the end of the tunnel. And right now, the situation we're in, it doesn't feel like that. It feels like this sort of we're floating along with a very limited understanding of where we're going. We know that things literally changed overnight. I mark that moment as the demarcation line was the middle of March, March 15th, which was the second Fed rate cut on a Sunday, basically to zero. And I think you had to live in a cave on a desert island to not realize that the economy had changed significantly. Mm-hmm. I actually have a good friend who's an appraiser in California, and he argued with me that it was March 11th, which was the day that the Tom Hanks and his wife announced that they had the virus.
Positive.
And then I had a friend of mine, an appraiser in Chicago, dubbed this moment sort of from Hanks to Banks, that it was this demarcation. But the reason why I bring that up is, and why it seems so different to me, is that that really, with the fact that in New York City, the brokerage community can't physically show property yet. They can do virtual tours, but I don't think there's going to be tremendous adherence to buying. I think that's on the margin. You're not going to have mainstream transactions simply virtual. And so we're in this new time.
So you made a great point while we were talking earlier about it. There is no data yet to support whether we've hit the bottom. Talk a little bit about that idea. I mean, just the fact that
Sure.
Sales right now, when people ask, is now a good time to buy? What is the response to that?
So I never give people advice on is it a good time to buy, because everybody's situation is so different. Mm-hmm. But the way I look at, so first of all, the problem with using the word bottom is that it implies improvement, that maybe a V sort of shape recovery. And honestly, at this point, we really don't know yet. We have logic and reason, but right now, anecdotal is king. And there's not a lot of data. And what I mean by that is what we've learned in a crisis that's changing day by day is that the data points that we're used to, whether it's contract activity, closing activity, inventory, have all been impacted. In fact, we've learned that contract data in this cycle, especially now, is literally a lagging indicator by as much as 4 weeks or even longer, simply because, and the reason why I had brought up that example is sort of the pre and post COVID line of demarcation, is that a tremendous amount of the contract activity that's being cited. Hey, a broker will say, hey, I just got a deal, a written signed deal on a, $3 million apartment or whatever. Every time we look into that closer, it seems that transaction is literally linked to something that happened pre-COVID. In other words, somebody looked at an apartment and then they, started focusing on another property, and now they're coming back. So they can actually sign a contract, which in and of itself says something about sort of the future outlook. But the fact that they are willing to sign it, but that they're in a position where they physically inspected it versus, someone who is just coming in right now.
Right. Well, given that though, let's try to frame that for folks in the sense that, prices were sliding for several years in Manhattan as it was already, even before all of this started. In your last report in the first quarter of this year, things were looking pretty good until this happened. And it seemed like sellers were starting to capitulate, as you said, and things were getting better. Give us a sense, though. I believe it was that the median price was 6% down year over year. People are probably curious, how much farther can prices dip as of now? And maybe, as you mentioned to me, what happened right after 9/11 and 2008? How long did it take for prices to recover, and how far did they fall?
Right. So a couple of points to that. So one is, the Manhattan market median sale price on a year-over-year basis was down 1.4%. And we saw for the last couple of years since the implementation of the SALT tax in early 2008, or January 1st of 2018, rather, the higher end of the market has been more challenged. On top of that, we had the mansion tax. We had the new rent law in 2019. So there's been a lot of headwinds that have been sort of thrust at the market already. What we saw at the end of 2019 into the first quarter, and in fact, I cover about 35 different housing markets around the US for Douglas Elliman Real Estate, lots of markets in South Florida, California, and the rest of the New York metro area. And almost every market in the first quarter, and when we say the first quarter, you have to remember that the demarcation line occurred in the first quarter. So we really want to say the first 2.5 months of the quarter, we saw a real uptick that suggested that the spring market was going to be pretty robust. In other words, if you're in a weak market like Manhattan, it was showing strength. If you're in an already strong market, it was showing greater strength, that the direction universally seemed to be rising. The second that we hit this demarcation line, sort of, all bets are off. And I guess the only lesson we learned from the first quarter is going into this contagion or this virus. When we get to the other side, it's probably better that the market went in with strength or improvement in terms of activity, because sales are up year over year about 14%. That would help, the other side, what the other side looks like. We don't know.
And I think I want to segue there to Nancy Pax, who's also on the call. Nancy, who heads her own firm and consults with many big developers in the city, and also analyzes a lot of the new data that comes in. And Nancy, late last year, you put out a report showing that in Manhattan's condo market, almost half of all the new condos that came to market after 2015 were unsold. And it was one of these sort of stark reminders that there was a glut of inventory built in Manhattan, very expensive inventory. And then COVID happened. So what position are those developers in? And what does the future hold for those people who are the developers who were already struggling?
Hi, Stefanos. Thanks.
Sure.
So yes, thank you for recapping where we were before COVID came in. So we did have an inventory overhang, which was largely the result of the success of the market. Prices had accelerated greatly, and that caused a certain resistance at a certain point to higher prices. The trade-off to that was that the resale market, which didn't have the same increased prices, was in fact very good. So the fundamental market demand in terms of overall number of transactions, if you take new development and resales together, was quite good. Of course, we had a very good job market, so it's understandable that that would have been the case. But specifically, directing your question concerning the new development market, the individual buyer, as opposed to the investor, has little risk tolerance. And I think your earlier question to Jonathan, is this a bottom, is the key question for the future of the new development market. Mm-hmm. In order for this to be a bottom, the consumer must see that there is a resumption of volume of activity and perhaps an uptick in prices at the other side of the COVID crisis. But I think a point needs to be made that unlike prior financial crises, this is not merely a financial crisis. This is also a condition. So it's an event, but unlike an event like 9/11, it's an event and a condition. And the real uncertainty here is how the condition plays out. And by this, I mean, we have a real issue here about people possibly working from home, which will influence the location that they buy in. If one can actually live in Coney Island and enjoy the ocean and still be at work, well, that's a choice that didn't exist previously to quite the same extent. So the knock-on effects of the virus are altering the way we live in terms of how certain locations will benefit with increased demands, how others might not. So we have several variables here that are still unknown. The resumption of growth in the local economy. So let's stop for 1 minute there. This is clearly the source of demand. New York is the greatest city in the world because it has the greatest variety of industries, going from the stalwarts of finance and law to the vanguard of all the telecommunications industries. They are the largest companies, they have the longest leases. So New York as a commercial hub has tremendous built-in stability to generate jobs, whether those jobs are being performed in the offices or in people's homes. New York will be, for the near term and the foreseeable future, a tremendous powerhouse as it's always been. But how quickly the economic activity resumes is the question. Will it eventually? Yes, because these are the biggest companies in the world.
And on that point though, Nancy, just the folks who were already sweating before this started, what is their near-term reality going to look like? The people who are already on, their inventory loans, their second extensions of those loans, and now the lender comes to call. Does that mean that in those buildings, buyers can get a better deal today?
Yes, I think it depends on who the buyer is, Stefanos. There are two classes of buyers. The investor buyer, who has a much greater risk appetite. We've seen some evidence lately in the press of bulk deals being done. Mm-hmm. The investor's job is to take risk. So the bulk deals will probably happen to a much greater extent now because of the maximum uncertainty that the current situation poses. The individual buyer cannot take that kind of risk with the most important transaction usually in their lives. They'll wait and see how economic activity resumes and how different locations benefit from the work from home phenomenon. But having said that, there's another factor here, which is at the end of every crisis or at the end of every cycle, and they generally coincide, meaning the real estate cycles in New York have always coincided with an economic cycle. Here, this is the first time that the cycle's literally been brought to the end by a pandemic rather than a financial event. But at the end of each of these, we were always left with unsold units which went into the rental market temporarily. Eventually they were sold, they didn't stay in the rental market. And that will happen here as well. A certain amount of the inventory, particularly in the outer boroughs where the condominium inventory is very, very much like the high-end rental inventory. Many of those buildings will be able to transition out of the condo market into the rental market.
And you had done an analysis that we were looking at together in which you estimate that there's probably about 2,700 condos today that were going to come to market in 2020 that are in the price range where they could probably convert to rental. And I found that fascinating because that would roughly double the rental pipeline for the rest of 2020. So no one knows how much of that is actually going to convert to rental, but what is that going to mean for the rental market?
So Stefanos, just to frame that, that little snapshot was only relating to Manhattan condominiums that are in a price point where they could probably convert to rental. The outer borough markets, it's actually practically all of the outer borough condominium inventory can become rental inventory. It's designed very much like high-end rental inventory.
Nancy, I have a great question here actually that dovetails here. A reader, Hank, wrote in, how will rental rates be affected, especially if there might be a surge of evictions after the moratorium ends?
Great question. So we need to realize that to the extent that the condominium market may be on hold because of uncertainty, that demand from the person who would have bought comes into the rental market. So the demand pool in the city of New York is very fluid today. Rentals are designed with condominium finishes. We're building family-sized units in the rental market. There's much more ability to transition from sale to rental when something like this happens. So the demand that would have previously been in the condo market goes into the rental market to help to absorb those very same units, only now they have a different brand on them. Now they're called rentals. So the real question driving demand is, to what extent do we recover lost jobs? So it's really the economic recovery which affects pricing, not so much the supply side. It's always the demand side. But again, we have to remember that these are the biggest, most diverse industries in the world. These companies are best positioned to go forward. They're not going to collapse like smaller businesses in a liquidity crisis. So there's every reason to believe that the economy will recover in New York. We don't know the when. It's a little bit complicated. There's no way to foresee that. But the near-term outlook is for the recovery of that demand, the absorption of these units, the stabilization of the housing market. But clearly in the near term for the individual condo buyer, the picture is too murky to really understand at what moment one could feel that the asset they are buying is going up and not going down in value.
And that's a good segue for our other panelist, Frances Katzen, who's on the line. She is a top agent with Douglas Elliman. She's boots on the ground because I know that she covers everything from studios up to $1 penthouses. So Fran, who is benefiting most in this market? If you're bold enough to buy, which segment is benefiting?
That's a really good question. The buyers that are taking opportunity in this climate are people who want to diversify their equity. They recognize and understand the cycles of real estate, even in a pandemic, which is murky. There still is an inherent global bid for New York real estate. And what we're finding is there are people who have the means, and I'm talking about people over $4 million, who want to diversify their portfolio. They recognize that they're buying at a low point. They can smell blood in the water. Leverage is cheap, and they are prepared to play because when there is fear, there is negotiation. And when there is uncertainty, there is opportunity. And what we're finding, and it's ironic because people think, really? We just did a sale. The woman is relocating back to New York from Belgium. She lived in the building, but never went into the actual property that I had and bought the apartment of a Zoom showing.
So sight unseen.
That happened twice, sight unseen. And it's sort of in the same concept of buying new construction, really. And that goes hand in hand with the perception. There is a perception for people. It's like the stock markets. When there is fear, people panic. When there is a sense of connection to it, it works. And right now there's two camps. The world is ending, or there's an opportunity, and the pendulum is swinging into a very different space. But all of it is unknown.
So I'm hearing from you that the top of the market is where the discounts will continue to be pretty wide.
Absolutely.
Whereas we've also mentioned, we've spoken about how on the starter market, and whatever that means in New York, I mean, it's still an expensive apartment, but that those units are still supply constrained. So discounts there, people might be expecting fire sales, but really the discounting there is what exactly? What are you seeing there in the starter?
Well, that segment by nature has the least to spend and the most to lose. And they are really, we've had, there's been this talk pre-COVID that we had job growth, but we didn't have wage growth. So there's this disconnect for the entry market, which is if they can't satisfy the ability to achieve a jumbo loan, they're not going to get it. Or if the banks are analyzing the past 2 months of bank statements and they've just been told that they have to take a pay cut by 30%, that impacts their DTI or debt to income. So that is the most sensitive climate. And that's usually been my barometer to determine whether or not the market is coming back, because those are the people that are recognizing the value proposition of getting into a bigger space rather than staying in either a rental or staying in a studio. They want to buy up because that's the commodity in New York space.
And let's just define jumbo loan there for folks unfamiliar. In New York, even starter apartments will require financing that exceeds the typical, what is it, not conventional loan, conforming limits. So we're talking, how much is it in New York?
665,500. It's something like that. It's 670,000 or give or take.
Yeah.
And the credit score now is much more scrutinized. It used to be that you could have something a little under 700. Now it's 720 minimum. So if you've got student debt, that's tough.
So I'm also hearing that on the flip side, there are higher barriers to entry, even though the prices may have come down a bit and the mortgage rates are good.
Well, the banks are nervous,
And 2 things here. Just a reminder to folks writing in with questions, please give us your name to let us know where you're calling in from, because we'd love to shout that out. And here's a question from reader Stephanie, who's a nurse in New York. As an essential worker, is there any grant or loan I should apply for? Are there any first-time homebuyer programs available right now to me?
Yes, some banks, B of A included, have a doctor loan for nurses, programs that allow for higher % financing levels for actively practicing doctors. In normal, inverted comma, times, you can get as much up to 90% financing on about 1.5 million mortgage if primary residence is the purchase. So there is ways to manipulate and get what you need, but you have to really do your digging.
And we recently put out a piece in the Times of Real Estate section on first-time buyers, and there's a few other programs mentioned in there as well, Stephanie, and to others who are curious. And in terms of, here's actually another reader question that relates well here. I think I just lost that one. Given everything, this is from Megan, is it a bad idea to sell if you just recently bought your place last year?
Oh, I mean, the capital gains tax is the one thing you want to be aware of. And I guess the question is, I think people are thinking that way because they've been living in their homes now since March 13th or March 15th and are going bonkers and are looking at the space going, we really need more space. So maybe it's worth pushing. But I think people are having to come to a place of reckoning whereby they may not sell for the same premium that someone did in 2015 or 2016 and 17. But the upside is that the buy-in for the bigger property is 20% below, right? In terms of its historical trades over time. So there's a big upside for people there.
And here's a question from Andy in Queens. I'm curious what effect this down market might have on requirements for down payments and the standards that co-op and condo boards have. Would you like to take this one, Jonathan?
Well, I can answer part of it, which is what we're actually seeing now, and this was alluded to by our 2 other panelists, is that banks are actually tightening up right now. And the concept is liquidity, that people are able to make their mortgage payments. So we're seeing less wiggle room on loan to value ratios. We're seeing higher credit scores, as Fran had mentioned, and just a lot more scrutiny and a lot less waivers or exceptions. And if you think about it, that's actually what banks should have done during the financial crisis. So there's a tremendous amount of risk mitigation going on by banks right now, which is kind of interesting. I would think that boards are going to feel the same way. All I have on that is anecdotal feedback, but they're certainly concerned as well about the ability an applicant to be able to make their maintenance payments in the co-op. So look at this as a period of tighter underwriting, higher scrutiny, but we don't know how long that'll last. In other words, I see this as this is of the moment, but this is something that's changing pretty quickly. And it really depends on how quickly we see some sort of snapback in the economy, if at all.
If I might, I'd just like
Yeah.
to add that you actually are seeing it right now in the one bedroom segment, especially in the smaller price points. Sponsors are now providing a payment plan where it's 5% down at contract signing and the remainder 5 or 6 months later, pending delivery date. So it is happening where people are feeling, and they're even offering the opportunity for the buyer to rescind once they can view the space, that it takes the pressure off the buyer to feel that they don't have an out.
There was one a property in a store here in Astoria, Queens, where it was a new condo starter market where it's only 5% down, and they are offering a money back guarantee, which is pretty unheard of. Because construction is continuing. Lots of people are asking permutations of this one. What are the chances, and I'll shoot this over to Nancy, what are the chances of a potential exodus out of New York City? Is there any early data indicating what's happening?
Well, see, I think the base of this pyramid is that demand comes from the major companies that are in the offices in Manhattan. During the lockdown, there was an enforced experiment where almost everyone worked from home and did so with a pretty good degree of success, despite the fact that, as Fran pointed out, working from home could drive you stir crazy after 3 months only being able to go to the drugstore and the supermarket. But the experiment was overall successful. Now, companies that have real estate in Manhattan will reconfigure the space they already lease to accommodate fewer workers with more space per person. And then the remaining people, almost by definition, will be invited to continue to work from home while companies feel out this paradigm shift to the ultimate benefit of working from home and giving people an hour and a half or 2 hours off, basically their commuting time, to be more productive and more creative in other ways. So I'd like to stop for a second on that note. For many years, Google has had a culture where in the Google offices, you're invited to go play ping pong, go write your novel, do anything else that you feel like doing except working in your cubicle. And I think they recognize implicitly that the creativity of the individual is hampered by being tied to a screen and a cubicle that is much smaller than the smallest apartment and told to produce for 8 hours a day. So what we're going to see coming out of this is, in a sense, much greater creativity, where creativity begins with the individual. But that shift away is going to take time to evaluate because it's such a major paradigm. So I don't think in the near term, we are going to be hiring people in Minnesota. We're going to keep the population local to come into office meetings occasionally. This paradigm will shift gradually. So I think the near term, this is pretty clear. We're not going to just disperse the population all over the globe because maybe it works. But the eventual outcome of this really remains to be seen in terms of how dislocated will the job be from wherever the quote business is.
So on that point, there's a reader, Lynn, writes in, and this is for, I think, Jonathan, to speak to this. And maybe these are the suburbs that benefit most if there will be an exodus from New York. Where do you think the impact will be on nearby suburbs in Long Island, Westchester, Jersey, and Connecticut?
Well, the answer is all the above, which is there's, I think the urban to suburban transition is going to be twofold. First of all, before we even get to that, how long do we think it's going to last? Because it's clearly happening right now. You can see markets that have released shelter-in-place rules, like suburban New Jersey, are seeing a big uptick in contract activity right out of the gate, which actually gives me a lot of confidence that when New York starts walking out of their apartments, that you know, it's that there probably will be some a jump in activity. But the other thing across the suburban markets, we're seeing the first wave of inquiries tended to be skewed towards rentals. Like, hey, I want to rent this house out and see if I like it here. And the suburban markets generally don't have, at least on the single family side, that enough volume or inventory for rentals. So we've actually seen we're starting to see a lot of pending sales activity in the surrounding suburbs. But I think that's going to be shared, that outbound migration is going to be shared with demand for second home markets. Typically after a economic downturn, a second home is a much more risky proposition. You know, it's called a second home because the primary home is really what you're going to focus on keeping if you say, you know, lose your job or get suffer a, loss of income. But I think there's going to be some structural rethinking about the second home market in terms of almost like a co-home or a co-primary home, something along that line where, maybe there isn't necessarily the same interest in trading up as there is in buying a larger second home, so that you can see them as equal or go back and forth with ease, as opposed to say just during the summer. And as a result, we're seeing a flood of early activity in markets like the Hudson Valley, upstate Connecticut, the Hamptons, and the North Fork. And I think the bigger picture with all this, and there's been a lot of discussion about the urban to suburban movement, but I really think that I haven't sort of signed up for the idea that this is a permanent structural. Maybe parts of it are. And the reason is, and maybe it's not a great comparison, but I just think after 9/11, there was a massive urban to suburban exodus, and it only lasted about 3 years, and then it cooled. So I'm not convinced that this is something permanent.
Remind me, Jonathan, you mentioned once before about the recovery time after 9/11 and 08, and I think that is instructive. How long did it take for prices to go back to normal after those events?
So in both of those markets, we saw price and sales. Well, essentially, if you look 2 years out, sales activity had recovered, and pricing had not fully recovered, but 70 to 80% of pricing had recovered. And it really took another year or two for each cycle was different. But essentially the market rebounded, in activity within 1.5 to 2 years, and prices really within 3 to 4 years, but most of it being recovered in the first 2 years.
May I add something to what Jonathan just said, Stefanos?
Yes, Nancy, please.
So one thing that's different here is this potential paradigm shift toward people working at home, forced into the experiment by the COVID crisis, but nevertheless proved successful. And we all have read the major companies that have announced they will adopt this. So this is what I think is really critical. For New York to remain vital in the long term, we need to look at the markets that Jonathan was just speaking about, not within commutation distance to Manhattan, but in the aura or the ambit, Dutchess County, the Jersey Shore. We need the high-speed rail link so that as companies perhaps shrink their need for office space in Manhattan, other companies come in because the buildings are there, and Manhattan can tap greater demand for those companies by embracing a wider territorial map. The key to all of this is high-speed trains. Otherwise, we are limited to the physical footprint of the city in terms of the influence exerted by the Manhattan office market.
And I have a reader question here from Sharon. This seems like a Fran question. Can you speak to the desirability of the resale versus new development markets? For instance, I think I know what she's getting at here with amenity packages. Do they now seem less attractive to buyers?
I think Sorry, the last part of the question?
On amenities, I'm thinking of swimming pools, gyms, and that sort of things that are shared and probably off limits right now because
I
of
see,
COVID.
okay.
Are they less
I mean,
attractive now? And does that change the calculus with new dev versus resale?
you know, I think there's two types of buyers that are more more risk adverse, and buyers who have done it enough that understand what it is and what it isn't. So resale tends to, you know, migrate to prospects who really want to be able to touch it, feel it, and can actually see the actual view and the property prior to signing a contract, and are looking at the amenities as an extension of their house or home for a family, growing family. But, you know, none of those amenities right now are going to be provided usage anyway until they have a mandate that allows it to be in code to whatever the requirements are. So the new construction buyer is someone who wants nobody in there at any point because of their own concerns of that, because they like it that way, and they're prepared to wait and take that risk and you know, wait for it to be built. But, you know, I think they're two very different buyers.
And here's a question about, you know, we talk a lot about the co-op and condo markets, but there's a ton of single family and townhouse homes in the city as well. A reader writes in asking, how will the townhouse market and single family homes be affected? This is from Nick in Brooklyn.
You're asking me?
Yeah, I'm sorry, Fran.
Sorry. Yeah, it's popular. We have two people that I'm working with right now who are only interested in townhouse. They were looking at very big, you know, new development properties and have now skewed into townhouse. And I suspect it's because of that feeling that it's all theirs and they don't have to deal with that, any other people. I think you're going to see an uptick.
Great. And just a question. Gotcha. And a question for all three of you. Reader asks, how has the pandemic shaped your own real estate investment plans over the last few months and coming year?
In what order shall we answer?
Yeah.
Yeah, you know, I think like anybody else, I look at, you know, real estate in terms of whether it's investment or home occupancy as a long-term
And we have
play.
a 5-minute on the final 5 minutes, guys. So let's wrap them.
Okay.
But go ahead.
So I see it as a long-term play, and really what's happening now is part of the question. The other part for me in terms of investing is I'm just finishing up paying tuition for 4 college educations. So I'm not really in the market at this moment.
That's daunting. Jesus.
What was that, Nancy?
I said finishing is the good part there, Jonathan.
Yes, this is true.
And Nancy, what do you say to that question? What would you be doing in this market?
Yeah, my weekend home, which has been my COVID residence, is in Dutchess County in Rhinebeck. Mm-hmm. And I personally, probably because I'm not in an apartment, I've had the greatest burst of creativity. The sense of openness, the contact with nature. I've solved problems that I worried about for months when I was locked up in my office that I couldn't crack the nut on. And I really feel that everything that happens like this, the creative destruction of capitalism, driven by efficiency, and here the efficiency is companies will pay less office rent because people will work from home, and that will lead to a more efficient capitalist market. You know, there's an inevitability about what capitalism does with efficiency. I think the net here is that it's going to be better for the individual to be in circumstances not confined and not having the stress of a commute. So I see great light at the end of this. I think that the fear of change in the meanwhile is difficult for everyone. Unknown and fear of change are the anathema in life. But I think that the eventual outcome here is very good.
And anything to add there, Fran, in terms of what you would be buying or selling currently?
I think this is the best time to be a buyer. Honestly, this is the most opportunistic climate we've seen in a very long time for people to take advantage of.
With
I'm a big believer in it.
Though, in terms of, as we've said, in terms of the barriers there, who benefits most there?
I think people who are looking to move up into the $3 million, $4 million sector.
But in the starter market for the folks with the living wage, I mean, everyday folks, are there opportunities for those folks?
I think so. I still think that the mortgage rates are so low that I think if they're on the fence,
Mm-hmm.
there are many people who are on the fence right now that will probably shift in if and only if they feel that their jobs are somewhat secure.
Right. Well, thank you guys so much for your time, Nancy, Jonathan, Fran. Thank you all to all our listeners who joined us today as well. I'm really grateful for your time and for doing this with you all. This conversation is part of a slate of digital events at Times, and we are going to be doing more of these all throughout this week. On Tuesday, May 26th at 2:30, we have David Gellis, who's the corner office columnist, and Emily Powell, the owner and CEO of Powell's Books, who will be on to discuss how to lead a beloved institution like Powell's Books through this crisis. And to find out more about our slate of digital events, please visit timesevents.nytimes.com. And I didn't stutter through all of that, so I'm very proud of myself. Thanks, everybody.
Thank you so much for having me.
Thank you.
Thank you.
Bye all.
Bye-bye.
Bye.